A founder who flew to space on SpaceX just bought 43,000 shares of his own company with his own money. At the exact moment Wall Street declared this stock left for dead, Shift4 Payments has been cut almost in half, from $108 last summer to $44 today. The narrative says debt-fueled empire building, AI is going to eat payments, and fourth quarter earnings cratered. The reality looks very different. Let me show you what I mean. Here is the one-line thesis. Shift4 is a founder-led payments processor compounding revenue at 26% a year, generating $500 million in free cash flow, trading at 8 times forward free cash flow, while the S&P trades at 22. This is a high-reward, medium-risk special situation. The entire investment case hinges on one question. Can management pay down their debt fast enough while the business keeps growing? Nothing you hear from me today is financial advice. Do your own work. But by the end of this video, you'll know exactly whether this stock belongs in your portfolio at today's price. Let's set the table. Shift4 Payments is a vertically integrated payments technology company headquartered in Allentown, Pennsylvania. They process over $200 billion in annualized payment volume across more than 200,000 merchant locations. They went public in June of 2020 at $23 a share, and today they employ roughly 4,000 people. The founder and still the executive chairman is Jared Isaacman. Yes, the same Jared Isaacman who commanded the Inspiration4 and Polaris Dawn SpaceX missions. He owns about 30% of the equity and controls the majority of the voting power. In March of 2025, he stepped back from the chief executive role. Taylor Lauber, the former president and chief strategy officer, took over day-to-day operations. The business serves 4 verticals: restaurants and hospitality through their SkyTab platform, sports and entertainment stadiums and arenas, retail, and as of 2025, global tax-free shopping through the Global Blue acquisition. Market cap is $5.6 billion. Enterprise value is $9.3 billion. The stock is down 59% from its peak last July, and today it trades at $44.19. Here's the simplest way to understand this business. Shift4 is Stripe for physical businesses that hate Stripe. When you tap your card at a restaurant, a stadium, a hotel front desk, or a retail store, someone has to route that transaction from the card reader through the card networks to the issuing bank and settle the money back to the merchant. That someone is called a merchant acquirer, and Shift4 is one of the biggest independent ones left in the United States. The revenue model is 90% transaction-based. For every dollar of payment volume, Shift4 keeps about 7 cents per $100 processed. At $200 billion in annualized volume, that's roughly $1.4 billion of gross profit. The rest of the reported revenue is straight pass-through of interchange fees. Here's the simplicity test. If you can't explain a business in one sentence, you shouldn't own it. Shift4 takes a cut every time a card is swiped at a merchant who uses their hardware or software. That's it. You could explain it to a high school sophomore. Now the industry. Card payments in the United States process around $12 trillion a year. The card networks are a duopoly. The acquirers are an oligopoly of roughly a dozen serious players. Merchant retention runs above 95% annually because switching costs are punishing. This is not a hype cycle. This is closer to a utility. Now the growth story. Revenue went from $1.37 billion in 2021 to $1.99 billion in 2022 to $2.56 billion in 2023 to $3.33 billion in 2024 to $4.18 billion in 2025. That's a 32% 4-year compound annual growth rate, and management is guiding next year to $5.08 billion, another 22% jump. Consensus Wall Street estimates call for $6.73 billion by 2028. The growth is not speculative. It is contracted, in place, and showing up in the numbers every single quarter. Let's talk about the moat, because this is where investors either pay up or walk away. Shift4 competes in the most crowded square on the payments chessboard, merchant acquiring. The competitive set is brutal. Global Payments, Fiserv, Toast, Block, formerly Square, Adyen, Stripe, dozens of bank-owned acquirers. So where is the moat? The moat is not in payment processing itself. That's a commodity. The moat is in the integrated software layer that sits on top of processing, specifically their SkyTab point of sale system, VenueNext for stadiums, and their custom integrations into hospitality management systems. When a restaurant or a stadium installs SkyTab on 20 terminals and trains every server on it, the switching cost to rip it out is measured in weeks of lost revenue. That's why Shift4 reports merchant gross retention north of 96%. But let me be honest with you about the competitive reality. Toast is a better software company in restaurants. Block is bigger in micro merchants. Shift4's Moat is strongest in mid-market hospitality, in stadiums, and post-Global Blue in tax-free shopping. In those specific verticals, they have real pricing power. In plain vanilla small business acquiring, they do not. The realistic Moat grade is narrow, not wide, not none, narrow. And the numbers back this up. Gross margin sits around 34%, operating margin around 10%, return on invested capital around 8%, all respectable, none of them Visa tier. This is a good business, not a great business, and that's exactly why you only want to own it at a beaten down price. Now the most important section of this video, the financials. This is where the stock got cut in half and also where the argument for buying it lives. Let me start with earnings consistency. Does the cash actually show up every year? Revenue for 4 straight years, $1.37 billion, $1.99 billion, $2.56 billion, $3.33 billion, $4.18 billion. No down years. Adjusted EBITDA went from $140 million in 2021 to over $815 million last year. That is a 6x in 4 years. Free cash flow went from negative $56 million in 2021 to positive $499 million in 2025. This is a genuine bankable transition from investment phase to cash cow phase. The 5-year free cash flow growth rate is over 70% per year. But here's the but. The but the market is fixating on. Reported earnings per share dropped from $3.36 in 2024 to $1.15 in 2025. That looks like a disaster. Until you unpack it. The drop is almost entirely non-cash and one-time. Acquisition amortization from Global Blue. Purchase accounting write-ups. Deal costs and higher interest expense from the new debt. Operating cash flow actually rose from $396 million to $712 million. The earnings drop is an accounting illusion. The cash is more real than ever, and the market is trading on the illusion. Now the balance sheet. This is where the bear case lives. Net debt went from $530 million in 2021 to $3.65 billion in 2025. It almost 7x'd. Net debt to EBITDA stands at 4.47 times. Interest coverage is 1.85 times. The Altman Z-score is 1.05, officially in the distress zone. Those are ugly numbers, and they are not fake, but read them in context. 90% of the debt is long-dated senior notes at fixed sub 6% coupons. They don't mature until 2027, 2029, and 2030. There is no covenant cliff in 2026. Interest expense is covered by operating cash flow more than 3 times over. The Piotrowski score is 7 out of 9, meaning the underlying quality signals all still flash green. The Benish score of negative 2.83 is well below the manipulation threshold. The books are clean. So here's the real question. Can Shift4 pay down its debt from 4.5 times EBITDA to under 3 times within 18 months? At $700 million of free cash flow and $815 million of EBITDA growing 20% plus, the math says yes. Roughly $1.4 billion of cumulative free cash flow over 18 months, plus EBITDA growth to over $1 billion, puts the debt ratio at 2.1 times by late 2027. Without selling a single asset, that is the hinge this entire story swings on. The balance sheet is stretched. It is not broken. It would survive a 2020-style recession. It would struggle in a 2008-style credit freeze. So you monitor it every quarter. Returns and profitability in one breath. Gross margin 34%, operating margin 10%. Return on invested capital 8%. Cash conversion well over 100% because of the amortization drag on reported earnings. Every dollar of accounting profit turns into more than $1 of actual cash. One yellow flag you should take seriously. Goodwill and intangibles are 64.5% of total assets. A big piece of that came from Global Blue. If that business underperforms the model, expect an impairment charge down the road. Impairments are non-cash, they don't change the thesis, they do embarrass management. Jared Isaacman is the story here. He founded this company as a teenager at 16 years old. He took it public at 37. He owns a massive equity stake, and he has demonstrated skin in the game over and over again. In March of 2026, about 30 days ago, at prices almost identical to today, he bought 43,000 additional shares in the open market. Not an options grant, not a 10b5-1 plan from years ago, a direct open market purchase at the bottom tick. That is the single most bullish piece of primary data in this entire report. Taylor Lauber, the new chief executive, has run strategy and M&A since 2018. He is widely credited as the architect of both the Global Blue and Worldline deals. Whether those deals end up being strokes of genius or leverage-fueled hubris is the question the next 6 quarters will answer. On capital allocation, management has been unambiguously in growth mode. Since 2021, they have deployed more than $3.5 billion on acquisitions. Finaro, Online Payment Group, Global Blue, and Worldline North America, which closed in March of 2026 for 70 million euros. The acquired revenue has grown. The integration costs have been heavy, and the return on that capital has been mid-single digits, pending synergy realization. A separate investor, Maestria Capital, bought 144,000 shares in February of 2026, roughly $10 million, disclosed through a Schedule 13G filing. There is one open question item. A shareholder investigation was announced in the first quarter of 2026 relating to the Global Blue merger. This is the standard objection filing you see attached to almost every large deal in the small and mid-cap space. It usually settles for a disclosure amendment and a token fee. Not material unless it escalates. Bottom line on management. Skin in the game is elite. Execution on M&A is aggressive, but unproven on the Global Blue deal. And insider buying at $44 is the strongest possible signal that the people closest to the numbers think the stock is too cheap. Let's do 4 valuation methods and then triangulate. I'll walk you through the math. Method 1, normalized earnings per share times a multiple. Strip out the acquisition amortization hit and the one-time integration costs from 2025, and you get pro forma earnings of roughly $4.80. Consensus for 2026 is $5.60. At 15 times, which is the 5-year average multiple for Shift4, and still below the payments peer median of 18, you get a fair value of about $78. Method 2, forward free cash flow yield. 700 million of run rate free cash flow divided by a reasonable 7% yield, which is where Global Payments and Fiserv trade, equals $10 billion of equity value. That's $147 a share. Even at a punitive 10% yield for leverage risk, you still get $103. The fair value range on this method alone is 103 to 147. Method 3, enterprise value to EBITDA peer comp. Shift4 trades at 11.4 times, Global Payments at 9.3, Fiserv at 7.2. Toast, the hot software name, at 52 times, Block at 22, at a 13 times multiple, a premium for growth but still below Block. You get an enterprise value of $10.6 billion minus $3.65 billion in net debt equals an equity value of about $102 a share. Method 4, reverse discounted cash flow. What growth rate is already priced in at $44? Running the math with a 10% discount rate and a 3% terminal growth rate, the market is pricing in just 4% EBITDA growth for the next 5 years, versus management guidance of over 20%, versus 4-year historical of 55%. The market is pricing Shift4 as if the business is about to stop growing entirely. That is the gap. Triangulating the 4 methods, my base case fair value is $82, bull case $112, bear case $55. Margin of safety at $44.19 is 47% to the base case and 60% to the bull case. That is a real margin of safety by any institutional standard. And conveniently, the sell-side consensus median price target is $82.38, 19 buy ratings, 10 holds, 0 sells. So how did we get from $108 down to $44? 3 stacked negatives hit in about 8 months. First, the AI eats payments fear. Starting in mid-2025, the narrative that large language models would disintermediate card processing took hold. Shift4, as a software-heavy acquirer, got tarred with that brush. The fear is wildly overstated. Language models don't replace card networks, and AI ordering integrations are actually a tailwind for the SkyTab platform. But the narrative crushed the multiple anyway. Second, the Global Blue acquisition closed in 2025 and doubled net debt. The market saw $3.65 billion of leverage on a company that used to run lean and immediately repriced the equity for risk. Selling was indiscriminate. Third, the fourth quarter 2025 earnings per share dropped sequentially from the third quarter print, because integration costs and acquisition amortization flowed through reported earnings. The algorithm sold the headline. The fundamentals, operating cash flow up, free cash flow up, revenue up 26%, never stopped compounding, not for a single day. The rally back begins when deleveraging proof shows up on the first and second quarter prints of 2026, and when the market re-rates the multiple toward the payments peer group. Now let me walk you through the technical setup. I use a 4-phase read. Phase 1 is market regime. The S&P 500 is sitting at 679, above both its 50-day and its 200-day moving average. The tech sector ETF is above both of its own moving averages, and it is leading the broader market. The regime is green, uptrend intact. It's safe to take long setups. Phase 2 is clean chart structure. Shift4 is in a severe downtrend on the weekly chart, down 59% from the July peak. The 50-day moving average at $50.32 is below the 200-day at $72.90. A death cross. That cross is still active, but price has been basing between $40 and $50 for the last 7 weeks, forming what looks like a classic washed-out bottom, with diminishing downside volume. The 52-week low at $39.90 is the line in the sand. Below 40, the technical thesis fails and the stock is broken. Above 50, we break the downsloping 50-day and clear the first wall. Phase 3 is the precision layer. The relative strength index, 14 period, is at 40.27, neutral to oversold, recovering from a reading below 30 in late March. There's a positive divergence on the daily chart, a higher RSI low against a lower price low. The MACD crossed bullish 2 weeks ago. The histogram is expanding positively. Stochastic is oversold and hooking up. Average true range is $3.62, about 8% of price. Elevated, but not insane. Bollinger Bands are squeezing. Down day volume is declining versus up day volume. Classic accumulation signature. Phase 4 is the kill switch. Here's the trade plan. Entry zone is $42 to $45, which is active today. Stop loss is $39.50. A close below 40 on high volume invalidates the accumulation thesis, and the balance sheet risk becomes the dominant factor. First target is $55. The approach to the 200-day moving average, roughly plus 25%. Second target is $72, the 200-day itself, and the pre-drawdown support zone, plus 63%. Stretch target is $82, the consensus fair value, plus 86%. The risk to reward on a full $44 to $82 campaign against a $39.50 stop is 1 to 8. Well above the 3 to 1 hard filter I need to take a position. Time horizon is 9 to 18 months. This is not a 2-week trade. This is a position trade, or a small core position with the patience to let the deleveraging story play out. Now, the bull case. Here's how this plays out in the optimistic scenario. By the middle of 2027, first and second quarter 2026 prints show operating cash flow running above $800 million annualized. Net debt drops to 3.5 times EBITDA. The Global Blue integration delivers the $100 million of announced synergies on schedule. Worldline North America adds meaningfully accretive volume. AI ordering integrations through SkyTab actually boost the attach rate instead of hurting it. And the market re-rates Shift4 to 14 times enterprise value to EBITDA, still a discount to Block, on rising EBITDA of over $1 billion. That math puts the stock at $112, which conveniently is the sell-side high target, a double and a bit from 44 in 15 to 18 months. Factor in the founder's open market buy from March, and you get an asymmetric payoff. Base case plus 86%. Bull case plus 155%. Worst realistic bear case negative 10% on fundamentals. Now the bear case, because every thesis needs an honest one. In the bear case, a consumer recession hits the United States in late 2026. Payment volume growth decelerates from 25% plus down to single digits. Global Blue's tax-free shopping business, which depends heavily on Asian and European tourism, misses its synergy targets by half. The second quarter 2026 print shows flat operating cash flow. Credit markets tighten, and the refinancing risk on the 2027 notes comes front and center. In that scenario, Shift4 goes through an equity raise at a dilutive $35 level. The multiple compresses to 8 times enterprise value to EBITDA, and the stock drifts down into the mid-30s, retests 30, and spends a year in the penalty box. Bear case downside from 44 is roughly 30 to 35%. The single biggest bear case trigger would be any missed interest payment, any covenant amendment request, or any disclosure of an equity raise. Those are the kill triggers. You watch for them every quarter. Let's talk catalysts and then run the blow-up risk checklist. Near-term catalysts in the next 6 months. Number 1, first quarter 2026 earnings. Late April. This is the first post-Worldline close print. Watch operating cash flow. Watch net debt. Watch integration cost disclosure. Number 2, a mandatory convertible preferred dividend is due May 1st. 6% Series A, $1.50 per share. Routine if paid, catastrophic if skipped. Number 3, a Global Blue synergy update will very likely show up on the first quarter call. Management has committed to $100 million. Number 4, a rumored investor day in mid-2026 could reset the narrative. Now the 10-point blow-up risk checklist. Debt maturity wall. No maturities in 2026. The 2027 notes are callable. Medium severity. Low probability. 1 out of 5. Covenant risk. The senior notes have maintenance covenants on leverage and coverage. There is room. There is no huge cushion. Medium severity. Medium probability. 2 out of 5. Customer concentration. No merchant represents more than 2% of revenue. Low risk. 1 out of 5. Regulatory. Card interchange regulation. The Durbin 2.0 fight could hit processing spreads. Low probability near term. 1 out of 5. Integration failure. Global Blue and Worldline are both complex. Failure would impair over $2 billion of intangibles. High severity, medium probability, 3 out of 5. Key man risk. Isaac Mann is the face and the voting control. If he exits the chairman role, the equity loses a piece of its identity. Medium severity, low probability, 2 out of 5. Technology disruption, AI ordering, stablecoins, account-to-account payment rails. Long-term severity is high. Near-term probability is low. 2 out of 5. Accounting aggressiveness. The Benish score at negative 2.83 says the books are clean. Low risk. 1 out of 5. Goodwill impairment. 64% of assets are intangibles. If Global Blue underperforms, expect a write-down. High severity but non-cash. 2 out of 5. Macro recession. Payment volume is pro-cyclical. A recession hurts. Medium severity. Probability unknown. 2 out of 5. Aggregate blow-up risk score is 17 out of 50. Moderate, manageable, and entirely debt-centric. You position size accordingly. Here is how I think about this stock after looking at every line item, every peer, every chart, and every filing. Shift4 Payments is not a perfect company. It is a good company trading at a great price for a specific reason. An aggressive debt-funded acquisition sprint scared the market out of the name, and every other piece of evidence says the business underneath the balance sheet is healthier than it has ever been. Revenue is compounding at 26%. Free cash flow is at $499 million and climbing. The founder just bought 43,000 shares with his own money. Analyst consensus is $82. The technical setup is a multi-week base on declining volume above a 52-week low, with the broader market regime flashing green. The single most important data point in this entire report is the March 2026 open market purchase by Jared Isaacman. When a founder who already owns 30% of the company, who controls the majority of the voting power, and whose net worth is deeply tied to this one equity, reaches into his own pocket and buys more shares at $44 after a 60% drawdown with full knowledge of the numbers the market hasn't seen yet. That is as close to a tell as you get in public markets. He thinks it's cheap. The numbers say he's right. My verdict is a high conviction buy with a 9 to 18 month holding window. Entry zone is $42 to $45. Active today. Stop loss on a close below $39.50. Base case target is $82 for an 86% gain. Bull case target is $112 for 155%. Position sizing, 3 to 5% of portfolio for aggressive investors, 1 to 2% for conservative. Given the balance sheet risk, required monitoring is every quarterly print. Specifically operating cash flow, net debt, and integration cost commentary. If you only own one beaten down payments name heading into the second half of 2026, this is the one I would own. One last thing before you go. Nothing in this video is personal financial advice. I may own shares of the names I talk about. I may trade them. The numbers here are accurate as of April 11th, 2026. Do your own work. Size your positions, and never risk more than you can afford to lose. If this kind of senior analyst breakdown is useful to you, hit the like button, subscribe to the channel, and drop a comment with the next ticker you want me to cover. I'm looking at Toast and Adyen for upcoming reports. Thanks for watching. I'll see you on the next one.